So we're going to discuss the concept of safety, income, growth. It's a very simple concept with there's a lot more to it than just those three words, but it really sets the foundation for what I think true planning should be developed as. And whether, there's people that have tried to, if other folks or advisors try to copy it, great, because that means more good advice is out there, right? Mm-hmm. And there's more people getting helped by good planning. And it's, I'll kind of go back and forth, but Matt, I know we mentioned this last segment. I was listening to a podcast and it said how a lot of firms, they'll charge two different ways. They'll charge for their investment management, mm-hmm. then they'll charge for financial planning. Two separate fees, right?
Yeah.
And so at SAP Financial, that's I think it's a huge advantage. Our fees are very reasonable in terms of if you have more than $500,000, the highest fee is 1%, and it goes down to all the way to 0.4% based on asset size. But that includes the portfolio management, as well as all the planning that goes around someone's plan, whether it's tax strategies, having a portal where they can see all their accounts on one place, an income plan, a tax plan. And so I think it's a huge difference, because a lot of firms will charge like 1.75% mm-hmm. just for investment advice, then a certain fee for planning. Mm-hmm. And if you don't, a lot of folks when they come in, and you know this, Matt, they'll say, I didn't realize this type of planning existed because I've only had a portfolio of assets my whole life. I never had the two talking to each other.
Well, and that's what I think I pride ourselves on so much. And even times like this where obviously volatility is high. You can just say, look, because of how we're structured, because we are doing all those other areas, because when you first came to us, you probably had more of a junk drawer of stuff, and
exactly.
as we like to say, more of a portfolio than an actual plan. But everyone, after they've been through our full process, and it is a process. I mean, we're not talking like people meet us for one meeting and that's it. It's like, I mean, if we do engage, I mean, you're talking a 4, sometimes a 5 meeting full-term process where we're spending the time with each client, going through each one of these elements, and so that when times like this strike, people, they're still feeling pain. I mean, we're all feeling the pain of the sell-offs, but they've more confidence and they have a little bit more security, because at least they know, okay, we didn't know when it was going to happen, we didn't know what the reason was, but we always thought that, and always believed that volatility is normal. It's just the way it is. So it's like you need to have a plan, because volatility is going to come one way or the other. And that's why we structured the way that we do things.
Well, Matt, we talked about you can get a portfolio anywhere. You can get an annuity anywhere.
Right.
There's only one place that I know of where you can get an SHP retirement roadmap. Sounds cliche, but that's the roadmap is the guide to retirement. Mm-hmm. And so when it comes to income and investment planning, the 3 terms you mentioned, that when we talk about generating a plan, a cash flow, making sure what a cash flow is when you retire, your paycheck stops, the bills keep coming in. Where does that money come from so that you can live the life you want, do the traveling, whatever it is you want to do? Well, we kind of think of, let's say someone has $1 million, and I'm going to share next segment on some kind of specific examples, but on $1 million, there's only 3 places, in my opinion, you can put your money. Money into the safety bucket, money into the income bucket, and money into the growth bucket. So let's define each bucket let's define like what each bucket is, and how do we decide what money goes where. So safety, right?
Yeah, so I'll kick off with safety, and let me just be clear that when we reference safety, we're talking about things that are FDIC insured.
Yep.
That are truly safe because of the fact that they have some type of government insurance program behind them.
And fairly liquid.
And fairly liquid, right? So now I just want to make sure we understand the term safe. We have to, for compliance purposes, make sure that we're really sort of making it clear, kind of what we refer to as safe money.
Correct.
Now let's talk about what the goal is with safe money, right? So it has to have some type of government insurance, like for example, like the FDIC. And the biggest goal with safe money safety is really kind of like your rainy day fund, your emergency fund. People often talk about needing to have 3 to 6 months worth of their income in cash. Because the furnace could go, and we sometimes joke around like what happens if your tire blows on the way out of the way out of our meeting. It's like you got to have some money for that tire or your furnace or whatever that is, or maybe you were planning on traveling. You need to have a certain chunk of money that's fully liquid, fully safe, and unfortunately, it's probably not going to earn you much interest rate nowadays. But you automatically need to have something set aside because a rainy day is going to come, whether it's again an emergency or a furnace or a car or whatever that may be, or again whether you're traveling. But you got to have money set aside because when events like this are happening, it's nice to know that we have a big cash reserves set aside.
Yep. So that's one place that everyone should have some money for rainy day, house roof leaks, car breaks down, whatever it is. There's money there to cover that quickly. You don't have to sell anything quick, it's just there.
Right.
Next bucket is probably the most important one, which is the income bucket. And without income, there's no retirement, because when your paycheck stops, when we're sitting down with folks and clients that we meet with and folks like yourself that we're building these plans for, when the paycheck stops, we have to replace that to cover your expenses. So when we say income bucket, I'll start it off by saying the goal is, let's say you have Social Security of $50,000 a year and a pension of $1,000 a year. So let's say you have $60,000 coming in. Let's say you need $100,000 coming to cover your expenses. Just a random thing. You're short $40,000. So, and some of you might be short $10,000. Some of you might be short $100,000. I don't know, but the concept's the same. Is how do we fill that income gap so that your lifestyle doesn't suffer?
And there's a whole universe of investments that are specifically sort of geared or designed for income.
Yeah.
Most people, they might immediately think of dividend-paying stocks. Like, okay, great. Something like AT&T or Verizon or something along those lines. They pay a dividend, or they are, they hope to. Sometimes, obviously, it's a bit dicey at times. Like, for example, GE cut their dividends. But, dividend-paying stocks, real estate, like real estate investment trusts, bonds. Whether it's corporate bonds or municipal bonds, these are all designed for income. And then you have sort of like the one big taboo word that we like to really kind of let people know, but then you also have annuities.
Yeah.
And there's different forms of annuities, of course, but most annuities, if not all, are designed to perform some type of secure income to fill that gap.
The problem is you have one side of the fence that just says that only sells annuities, so they're going to tell you put everything in annuities. Then the other side of the fence that just does the market. They say annuities are the worst, you're not going to make anything, and so, but in reality, there are maybe out of 1,000 on the market, maybe not that many. There's probably 3 to 5 that can protect your downside, give you a little bit of upside, and provide you steady income.
Right.
And so when we're building an income plan, we don't care if it's called an annuity, a stock, or bond. What is your goal, right? And so we fill that bucket with the appropriate money to give you income for the next 10 years, or sometimes for the rest of your life, depending on the situation. So real quickly, we're kind of coming up to the break, Matt. But if you have enough money in your safe bucket for rainy day funds,
yep.
If you have enough money in the income bucket to cover your income needs, then your growth money, stocks, ETFs, mutual funds. If the market's down in that bucket, guess what? You're okay, because you have your safety and income needs covered because you built a plan. And so that's why I can't imagine not having a plan in place if you're close to or in retirement.
Right.
Imagine everything's market-based. That's why we divide up accounts between safety, income, and growth. We're going to get more specific next segment, but this is crucial, folks. If you don't have a plan like this, or if you're saying, wait, that sounded really good, but my plan does not sound like it's like that, get a second opinion or get a first opinion. This is your retirement savings, folks. You've worked your whole life. We've been doing this since 2003. We're a fiduciary-based planning firm. And take us up on the offer. We have a few appointments available over the next 2 weeks to sit down and go through this for you and your family. The number is 800-227-7777. When you book a visit, we're also going to mail you a copy of our book, the SHP Retirement Roadmap, which kind of gets you familiar with our process and gets you prepared for that meeting. Again, 800-227-7777. Or you can also book a visit right online at shpfinancial.com. Stay tuned after the break. We're going to go through more. We're going to share through a story that has to do with this safety income growth and share some ideas on how maybe you can think about your particular plan and some ideas on maybe some strategies you may change to build your plan correctly within the safety income growth parameters. We'll be right back.